Once again, the U.S. yield curve is flirting with another broad-based inversion. And once again, this fans the fears regarding the fate of the economy. But the question is becoming, does the yield curve inversion say more about the state of the world than the state of the U.S. economy? Well, let's take a look. Treasuries now make up more than half of all global haven assets. According to Eurozone SLJ Capital, this is double the share they accounted for during the financial crisis, and this appears to be complicating matters when long and short term yields flip. What had been a reliable American recession indicator is now instead a barometer of investors diving for cover worldwide. This has become more apparent with the threat from the coronavirus that continues to grow. In the search for safety and duration, the world is turning to U.S. Treasuries. As you can see from this chart, after a brief rest last week, the curve is once again flattening and the gap between the rate on the 10-year and 3-month Treasuries has narrowed. For now, there aren't many alarm bells in the American economy, with unemployment rates near 50-year lows and the longest stretch without a recession since World War II. Even with GDP forecasts indicating that the U.S. economy may grow more slowly, the only real explanation for the yield inversion can be the global hunger for U.S. bonds when the world sees trouble. I currently don't see anyone reaching for China as a safe harbor. So, a good question would be, where are rates going to go? During our lifetimes, none of us have seen negative interest rates. However, there are currently many sovereigns with rates that dwell in negative territory. According to visual capitalist Dorothy Neufeld, there is about $13 trillion of negative yielding debt. This new interest rate climate has many investors wondering, where is the bottom for interest rates? Are we going down? There are many who call negative interest rates absurd, crazy, or even strange. But to get a better understanding, it's always good to stop, step back, and get a bigger picture of the situation. So, step back with me to the year 1311. That's 800 years for those of you who are counting. As I said, there are many negative interest rates in the world. As an example, investors in 5-year German bonds currently earn negative 0.6% per year in interest. In other words, investors in those bonds are paying the government of Germany for the right to hold a bond for 5 years. But it gets worse, since inflation in Europe is expected to be about 1.5% per year. So combined, the negative rate and inflation will cost the bondholder a total negative return of about negative 2.1% per year. How do you like them apples? Considering a negative 2.1% return seems totally ridiculous. But in a recent Bank of England staff paper, economist historian Paul Schmelzing showed that negative interest rates aren't that odd. Schmelzing gathered 800 years of data on interest rates and inflation going back to the early 1300s. According to Schmelzing's data, real interest rates have been gradually falling for centuries. Real interest defined as the rate of return one gets on a bond or a loan after adjusting for inflation. This here is one chart that Schmelzing plots from the non-marketable data he collected and clearly shows the gradual decline since the year 1311. To get a better understanding of interest rates over time, here is another chart from Schmelzing's paper. The previous chart showed non-marketable loans to government, whereas this chart combines non-marketable loans with marketable ones such as municipal debts which were traded on secondary markets. This chart compiles the data from UK, Italy, Germany, France, Spain, Holland, the United States, and Japan, and has been adjusted for each country's GDP. The line in this chart illustrates more clearly the general downtrend in interest rates over the last 800 years. Based on the calculations, rates have been falling at about 1.6% each century. Interestingly, the downtrend has continued despite the various changes to the monetary systems, such as from a gold standard to a silver standard to bimetallic standard and back again. Most importantly, the downtrend continues through the final shift to our modern era of fiat money. Now, if you were listening only to cable business shows, the downtrend would never have crossed your mind because what we hear is that fiat issuing central banks are the ones to blame for abysmally low rates. But as this last chart shows, negative real interest rates were fairly common in eras prior to central banking and fiat money. So don't hold your breath for significantly higher interest rates because that may be a thing of the past. And to be sure, rates may go up in the short term, but don't be surprised if rates continue to go lower in the long term. And for today, that's ChewDog Charts. Thank you.